Elevance Health, stock ticker ELV, formerly known as Anthem, is currently trading at $438. Year to date, they are down 12.6%, and over the last year, they are down roughly 6%. The stock price has suffered mainly due to uncertainties in the health industry where margins are under attack. The current price is pretty close to the 52-week low, and if we look at the dividend history, even though it only goes back 11 years, it's looking quite good and a quite strong growth. And as you can see here, consecutive years of dividend growth, 11 years, and consecutive years of dividend payments, also 11 years. But let's jump into a stock screamer and zoom in a little bit to see everything a little bit better and see whether or not it could be a buy at the current levels. As you can see here, the PE non-GAAP forward ratio is around 12, which is below the 5-year average, which is around 17 or 18, I believe. The dividend yield is 1.3% only, and the payment ratio is around 20%. So pretty good. It has very, very low short interest. And as mentioned earlier, the 52-week low, we are pretty close to it. The analyst target price is 567, and the target growth rate is around 12%. EPS growth above 10% sits at 19, and the return on equity sits at 17%. Jumping into the dividend data tab and zooming in a little bit to see everything a little bit better, what we're looking for here is mainly some continuity in the dividend payments and the dividend growth. So you can see here, what we see here is that the dividend growth rate from the different years, we had a very high one of 52 and then followed by a very low one of just 4%. That's not really what we want to see. We want to look closer at the last couple of years where we want to see here 18, 13, 15. So that's more steady growth, and that's basically what we want to go and take a look at. And with the payout ratio being so low, they do have plenty of room to grow the dividend in the future, I do believe. The dividend growth rate over the last 10 years is around 15%. Coming down here to dividend yield theory graphs, you can see the dividend yield theory on the left says that it could potentially be at a 10% discount. And on the right here, it could indicate as well that we have had a bit of a jump in the stock price being down. As you can see here, we are back in the blue area. It has been a long time in the red area, which could indicate it being overvalued, but then moves up into the blue area, could indicate being undervalued. And as you saw mentioned earlier, it could be potentially around 10%. And always looking at the time rate of return, you can see here that over the last 10 years, if you just had invested in the S&P 500 and in Elevance, you can see here that Elevance would have massively outperformed the S&P 500 and does not include dividends. But to find out intrinsic value of the company, we do have a lot of valuation models. The first one being the dividend discounted cash flow model, where we do take the free cash flow from the different years. We then sum all those together and find an average growth rate, which is around 20. I use a bit more conservative one, applied growth rate of 7%. We then use that growth rate to project future free cash flows. We can then discount them back using a discount rate to a present value of those future free cash flows. Sum all those together with the cash equivalent, the total debt, and the shares outstanding. We arrive at a fair value per share of $677. Jumping into dividend discount model, where we do take the dividend payout from the different years, we then average a growth rate from the different years together. In this case, it's around 16%. Even if we apply a growth rate of 16%, which was also in line with the dividend data we saw earlier with the weighted average cost of capital, since the growth rate is so much higher than the weighted average cost of capital, we do get a negative intrinsic value, and then we cannot use this for anything. So we'll exclude it in the summary later. Next one up is the multiples valuation, where we do take some comparable companies to Elevance Health, and in this case, we do take their PE multiples. We average all those together and use the median, combining that with the EPS of Elevance, and then we arrive at a stock price of $723. Jumping into the next one is the price to earnings variation model. We do take the PE ratio from the different years. We then take the last 5 years average, which is around 18. We then take the EPS for the last 12 months. On using all those together, we arrive at an intrinsic value of $463. Next one is the Graham's revised valuation model, where we do take the EPS of Elevance, we do take the PE of North Company, the growth rate, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds, combining all those together to get an intrinsic value of $582. If you're wondering why I'm using 32 in the override EPS here, that is simply because the Google Finance function to get the EPS automatically does not work. So if I remove this whole equation doesn't work. So I just put it in manually, and it's the EPS going forward from the next 12 months. Also having a free cash flow valuation, where we do take the price of free cash flow ratio from the different years. We then, as with the price to earnings model, we do take the last 5 years, average those together. We then combine that with the free cash flow per share, arriving at an intrinsic value of $458. The last one is a Peter Lynch model where we do take the growth rate, the dividend yield, and the PE ratio of Elevance, and combining all those together using the Peter Lynch formula, we arrive at an intrinsic value of $504. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel and like the video. And let's jump into the summary where we do have all the different valuation methods that we just went through. As I mentioned, I do want to exclude the dividend discounts, so let's say no here and see what everything comes together. So the average intrinsic of the remaining one is 568, which is roughly in line with the analyst target, if I believe correct. Yeah, 567 actually. So jumping back to the summary, you can see the current price being 438, the average intrinsic being around 568. So there could be an average current discount of, let's say, 22%. So even if we apply a margin of safety, let's say 20%, there's plenty of room at the current levels if you are interested in the company. I do think it's a solid investment due to the dividend and also the cash flows they do have, and they could potentially rise to a really nice valuation of around $560 per share, which is a very, very high upside of around 22 to 23%. The sentiment of surrounding the healthcare industry has gone down as fears about lower margins are arising, but I find it resulted in an opportunity for stocks like this because there are a lot of solid companies in the business, and I would definitely rate Elevance as a buy if you are interested in the long-term outlook of the company. Always do your own due diligence, of course, but for me personally, I think it's at a very attractive level, and it do have a very attractive financial and fundamentals background as far as I've looked into it at the current time. So thank you so much for watching, and I'll be seeing you in the next video.